taxes and DeFi. It's a lot, isn't it?
Oh, definitely. Makes your head spin sometimes.
I mean, just when you think you've kind of got a grip on crypto taxes, this whole decentralized finance thing just adds layers and layers of complexity.
And, figuring out what Uncle Sam actually wants. Well, it feels like you need a decoder ring sometimes.
Exactly. Which is why we're diving deep today. We got a link sent in by one of you. Thanks for that, by the way, to this YouTube live stream.
Yeah, this wasn't just like surface level chat. It was a really in-depth discussion.
Right, about something called a Voter Escrow Partnership, specifically looking at Curve finance, the protocol, and crucially, the tax side of things.
So that's our mission, really, to unpack the arguments made in that stream. The discussion was led by a guy named Noah Seidman.
We want to get into the details of his arguments about, how rewards earned from these voter escrow things and DeFi, how they might be treated tax-wise.
It's one specific interpretation, mind you, looking at existing laws but applying them to this very new tech.
Okay, and we need to be super clear about Noah Seidman. He's described as a legal investigator, an autodidact, really digging into law and accounting where it meets crypto.
But, and this is important, he's not a lawyer, not an accountant.
Absolutely critical point. So nothing we discuss here is financial advice or tax advice, period.
We're just exploring a viewpoint, a perspective.
Yeah.
Especially relevant, I guess, with the April 15th, 2025 tax deadline sort of looming out there.
Right. It's about understanding how some people are thinking through these very tricky issues.
Exactly, how one person is reading the rule book, basically.
Oh, okay. Let's jump into this voter escrow partnership idea. Seidman starts with his foundational principles, right? Like, where does he begin?
Yeah, his core approach, and this is really interesting, is to say, let's look at the law as written.
Meaning the actual Internal Revenue Code, the IRC.
Precisely. The IRC, written by Congress, and also what's called common law, basically, how courts have interpreted things over time through precedents.
So he's saying that's the primary source, maybe even more so than, say, IRS guidance or interpretations?
That seems to be his argument. Focus on the statute and the judicial decisions first. The original intent, how courts see it.
And he really zooms in on definitions, doesn't he? The specific words Congress use.
Oh, absolutely. Semantics are key for him. He mentioned Section 61. That's the big one, defining gross income, what even counts as income.
And Section 7701, you mentioned that one before.
Right. 7701 is full of definitions, and the definition of partnership in there is absolutely central to his whole framework. He's saying, don't assume the meaning, read what Congress actually wrote.
So it's the text, then the court cases, the common law.
Yeah, the common law builds up over time from court rulings. Supreme Court decisions are top of the pyramid, obviously, but other court decisions matter too. And he highlights this principle of reasonableness in how judges interpret the law.
Okay, and how does he position the IRS in all this? He calls it a collections agency.
Well, yeah, I think he means that descriptively, like that's its main job, collecting taxes. His point seems to be that while the IRS interprets the law, often, in a way that favors collection,
understandably,
individuals also have the right to interpret the law based on the code and cases in their favor. And if there's a disagreement,
then it goes to the courts. They decide.
Exactly. The judiciary is the arbiter. So it's not just what the IRS says the law means. It's what the law, through Congress and the courts, actually says.
Okay, that groundwork makes sense. So that leads him to this idea about the smart contract itself, the one distributing rewards in Curve, the feed distributor.
Yes. He proposes treating that specific contract as a nominee.
Nominee. Okay, unpack that for us. He mentioned a case, Bollinger.
Right, the 1988 Bollinger case. Essentially, a nominee is someone, or maybe something, that holds legal title to property or money for someone else, crucially, without having beneficial ownership themselves.
Like holding it in trust, almost?
Kind of, yeah. But applying this to crypto, where title is different, Seidman argues these smart contracts inherently operate with nominee interest. It's a really novel application of that concept.
So the code itself, because it automatically executes and holds assets according to rules, it's acting on behalf of the users, not for itself.
That's the core idea. He talks about the contract's independence. Its articles of formation being the code itself.
Articles of formation, like the operating rules.
Yeah, think of the code as the contract's binding agreement. It dictates everything, how assets move, who gets what, based on predefined logic. It's set.
And he contrasts this with the Tornado Cash situation.
Right. He brings that up as an example where the government went after the smart contract addressed directly. It just shows how new legal ground is being broken, how we're figuring out how law applies to code. That case is, still working its way through the courts.
Okay, so nominee status for the contract. Then comes the partnership part. How does he argue that people locking up their tokens in voter escrow are suddenly a partnership? Usually that involves lawyers and paperwork.
Well, again, he goes straight back to the IRC, Section 7701.
That definition section again.
Yep. And the definition of partnership in there is incredibly broad. It includes things like a syndicate, group, pool, joint venture.
Ah, so just grouping together for a common purpose through the protocol could fit that definition.
That's his argument. He's saying, based on Congress's own words, this collective action through the voter escrow mechanism is a partnership. Whether or not there's a formal agreement filed somewhere, it's the activity itself.
He even mentioned the First Amendment, freedom of assembly.
Yeah, just briefly, as sort of a supporting concept, people assembling digitally for a common financial purpose. All this is laid out in this memorandum he put together, the Voter Escrow Partnership Memo.
Okay, and that memo has 3 main pillars, you said.
Right. Pillar 1. It is a partnership under the IRC definition, regardless of IRS reporting norms like Form 1065. Pillar 2. This partnership doesn't have dominion over the crypto and the contracts.
Dominion. Okay, word again. You mentioned the Glenshaw Glass case. What's dominion mean here?
In tax terms, dominion is about having real, practical control and benefit over an asset. Glenshaw Glass basically says income is realized when you have clear access to wealth, it's realized, and you have complete dominion over it.
So Seidman's saying the partnership doesn't have that kind of control over the crypto locked in the smart contract?
Exactly. Even collectively, the argument goes, the partners don't have the same unfettered control as they would over assets in their own wallets. So maybe income isn't clearly realized in the traditional sense just because rewards are accruing in the contract.
Okay. And the third pillar of the memo
connects back to the nominee idea. When distributions happen, someone claims their CRV rewards from the feed distributor contract. He argues that's governed by Bollinger.
because the contract is just holding it on behalf the nominee interest.
Precisely. It's acting as an intermediary, passing assets from the protocol mechanism to the rightful owner, the partner.
So pulling that all together,
Yeah.
the potential implication is that the tax event for the individual might only happen when they actually claim the rewards.
That seems to be the crux of it. The memo leans on partnership tax law, where partners are usually taxed on distributions, but with these added layers of the nominee contract and the lack of dominion.
But then there's another twist, right? He argues the partnership itself might not even have taxable income.
Yeah, that's a key part. The argument is the partnership, as this collective group interacting via code, isn't selling a product or service in the traditional sense. And crucially, if it lacks dominion over the assets generating the rewards,
Then it hasn't technically earned income itself to pass through.
that's the line of reasoning. It brings in IRC sections 701, 702, 703, which deal with partnership taxation. If the partnership entity itself has no income, what gets passed through to partners upon distribution might be treated differently.
And Section 731 about partnership property distributions, how does that fit?
He argues 731 might not apply in the standard way because the feed distributor, being a nominee, isn't distributing property that was formally contributed to or owned by the partnership. It's more like it's facilitating the transfer from the protocol's reward mechanism.
Wow, okay, that's a lot to unpack. I can see why listeners had questions. Someone asked where to even start trying to understand this.
Yeah, and his advice was pretty direct. Focus on the law itself. Read the IRC. Read the court cases. Don't just rely on secondary interpretations, even from accountants necessarily. Understand the primary sources.
He did acknowledge accountants have liability concerns, right? Especially with something this novel, like not filing a standard Form 1065 partnership return.
Absolutely. Accountants are often cautious, and for good reason. He seemed to be suggesting a need for professionals willing to dig into the statutes passed by Congress themselves.
And he kept pointing back to the memo as the detailed justification, based on law and precedent.
Right. Not just an opinion, but an analysis grounded in specific legal texts and cases.
What about applying this outside the U.S.? Did he touch on that?
He did. His point was that while the specific laws obviously change country by country, the approach is universal, meaning looking up your own country's tax code, finding the relevant court decisions. That fundamental process of understanding the primary legal sources applies everywhere.
Makes sense. But what about the fear factor? The IRS? Someone must have brought that up.
Oh, yeah. It's always the elephant in the room with taxes, isn't it?
Pretty much.
He acknowledged the fear, but also talked about the practical reality. The IRS has limited resources. They do cost-benefit analyses. He mentioned the Tesos staking situation, the Jared case, as maybe an example where the IRS decided pursuing a certain angle wasn't worth it. Doesn't mean no risk, but it's context.
Okay. Now, the IRS has put out some guidance. April 2024, they talked about checking yes if you received new digital assets resulting from mining, staking, or similar activities. How does his argument square with that?
His take was, well, if a distribution from the feed contract counts as receiving new assets, then maybe yes is the truthful answer to that specific question. But don't read too much into just that checkbox. He argues it doesn't automatically define the tax treatment of those assets. It's just acknowledging receipt. The how and when of taxation is a separate question under his framework.
Got it. And he mentioned a Supreme Court case, Loper Bright, about agency deference going away.
Yes, Loper Bright. This is potentially huge. The idea was that courts often used to defer to how agencies like the IRS interpreted laws.
But not anymore.
Loper Bright signals a shift. Courts now won't have to look at the law de novo, completely fresh, based purely on what Congress wrote, without giving special weight to the agency's view.
So that could strengthen interpretations based directly on the code, like his.
Potentially, yes. It means arguments grounded firmly in the statutory text might have a stronger footing in court than they did before. It boosts the power of interpreting the law directly.
So if the IRS pushed back on this voter escrow partnership idea, what would their arguments likely be? And how does Seidman preemptively counter them?
Okay, so potential IRS counter #1. This isn't a real partnership. Seidman's rebuttal. Look at IRC 7701. Congress defined it broadly.
Counter #2. Why didn't you file a Form 165 partnership return?
His answer. It's software. A smart contract operation. It has no ability or mechanism to file IRS forms. It's a practical impossibility argument.
Counter #3, the big one. You owe taxes on these rewards.
Right. And his response ties back to everything. Congress sets the tax rules. Post-Loper Bright, your interpretation isn't automatically law. Under our reading of the statute in cases, the timing and nature of the tax liability is different.
Okay, but let's say you accept taxes due only when claimed. Couldn't the IRS just say you're delaying the inevitable? What about constructive receipt? Like, you could claim it, so you effectively have it.
He addresses that. This is where the nominee concept and Bollinger are key again. The argument is that the basis, essentially the cost or value when the asset went into the escrow, might be preserved.
Preserved how?
As it passes through the nominee contract to the partner. It's not like the partnership itself generated new income from nothing. It facilitated a transfer.
And because the partnership argument says it has no income itself, no product service, no dominion,
the distribution might not be treated as immediate taxable income to the partner. He talks about basis tracking, suggesting fair market value at the time of distribution is maybe the most reasonable point.
which could mean no immediate capital gains tax just from claiming if the basis carries over.
That's a potential implication he explores. He argues constructive receipt might not apply here because of the specific mechanics of partnership law and the nominee function. It's definitely intricate.
So how did the Curve community react to all this? He presented it to them, right?
Yeah, there was definitely engagement. He mentioned llama risk. They're known for digging into DeFi governance, and Risk asked some sharp questions.
Like what?
About formalizing it. Like, should the Curve DAO vote to officially adopt this partnership treatment? How does that work legally?
Sensible questions. What was Seidman's take? Did he think a vote was needed?
Interestingly, he suggested that while a governance vote acknowledging this view could be good for clarity, maybe memorializing it, it might not be strictly necessary from a legal standpoint.
Why not?
Because in his view, the feed distributor contract already inherently has that nominee interest built into its code, how it functions. The code is the agreement, in a sense. The vote is more like recognition after the fact.
And immutability plays into this, the fact that contract code can't be easily changed.
Big time. He argues immutability strengthens the case for the contract acting as this independent, predetermined nominee or intermediary. It's not like a traditional partnership where partners can just change the agreement on a whim.
He contrasted this with traditional partnerships again.
Yeah, and referenced Tornado Cashcan, pointing out how legal arguments around immutable code are evolving. It makes these DeFi structures potentially very different legally.
Okay. He also mentioned Paradigm's outlook for 2025 regulation. Stablecoins, market structure, crypto as commodities.
Right. Just touching on the broader context, if DeFi assets get formally classed as commodities,
That could bring in the CFTC, different rules, maybe different tax treatment eventually.
Exactly. This just adds another variable. He also mentioned a case, Yuketo, as a sort of warning about potential liability for token holders in unincorporated groups, but quickly contrasted it with Curve's immutable contracts, suggesting maybe a different setup.
So, wrapping up his core message on the memorandum, what's the main takeaway he wanted to leave people with?
I think it's that this is an interpretation of existing law applied to a new situation. It's not asking for new laws, not a political campaign. It's an attempt to say, based on the rules Congress already wrote and how courts have seen things, here's how this DeFi mechanism might fit.
And the three pillars, again, were partnership by definition, no dominion by the partnership, and basis preservation via nominee interest.
That's the core logical structure he presented, trying to prove those 3 points using the code in cases.
Okay, so let's try to summarize this deep dive. We've walked through a really detailed, pretty complex legal argument,
Definitely novel.
suggesting that maybe, just maybe, rewards from things like Curve's voter escrow could be seen through this lens of a partnership, with the smart contract acting as a nominee.
And if that interpretation holds, it could really change when and how those rewards become taxable income for the individual user.
But, and we have to say this again loud and clear, this is complicated stuff. It's one interpretation.
Absolutely. You're hearing about one specific analysis of law applied to cutting-edge tech. Before you make any decisions about your own taxes, especially with DeFi.
You absolutely must talk to your own qualified tax advisor, your own legal counsel. Get advice tailored to your specific situation. This is crucial.
Couldn't agree more. Essential.
For me, the real aha moment here is seeing this potential disconnect highlighted so clearly. You have standard accounting practices built for, banks and brokerages.
And you have DeFi, which operates on totally different principles sometimes. Code is law, immutability, distributed control.
Right. And the material we looked at really forces you to ask, does the old rulebook just neatly apply? Or does the unique nature of DeFi require a fundamentally different reading of those existing rules?
It's a fantastic question, and it leaves you, the listener, with something to think about, doesn't it? How do these legacy legal and financial systems cope or fail to cope with technology that moves so incredibly fast?
And maybe. Does digging into the fundamental laws yourself, the actual text of the IRC, the reasoning in cases like Bollinger or Glenshaw Glass, does that give you more insight or power than just relying on interpretations handed down?
It certainly encourages a deeper look. Explore the code, the cases, the concept of immutability. It's where law and this new technology are clashing and evolving right now. A space to watch.